what's going on, guys? Welcome back. Marriage, Money, and Mindset. We're your hosts. I'm Jared.
And I'm Alexis.
And we back, baby. Another episode, episode 8.
Yep.
Appreciate y'all watching the last show. If you haven't, go watch it. It was on, what was it?
Choosing a brokerage.
Choosing a brokerage.
Yeah.
Right. That was episode 7, right? Mm-hmm. Yeah. Because it's 8. Yeah. So, of course, guys, we appreciate y'all, man. We want to give y'all some,
recognition.
Yeah. Thank y'all.
Subscribing to the channel.
Right.
Interacting with us on social media. We see y'all. We hear you.
Yeah, we got some new subscribers, man. Thank y'all. Some new IG followers. Thank y'all.
Mm-hmm.
If it's your first time watching this, man, go ahead and subscribe, like the channel, share with a friend, a stranger, a coworker,
Got something good in store.
Yeah, man. Yeah. So yeah, man, we're going to keep this going. So this is going to be the third segment related to the stock market for the month of October in 2023.
Right.
So we're going to, be talking about the stock market this whole month. We've been giving y'all kind of like, a dumbed down version of, from what the stock market is to how to set up a brokerage. And then, of course, today being, how to choose companies or anything really, like basically how to choose what to invest in the stock market, right? Because, we get a lot of folks, man, they usually don't know. Man, I get text messages from people sometimes, just, hey, what you think about this company? And I'm like,
Me too.
They done.
Like penny stocks sometimes.
Yeah, like, man, it'll be a company that's probably just mentioned, we were the same way in the beginning. I can't front though, man. We were doing the same thing. Like I was just researching.
Not knowing anything about the company and purchasing it because of the price.
Yeah,
like
exactly.
Price.
Yeah, I think a lot of folks, they get messed up on the price of a stock.
Yeah.
Thinking that we're going to get into it, man. We're going to talk about all that here in a second. But yeah, so let's get into it, guys. So this episode 8, choosing companies to invest in. We got the easel, of course. Before we started, we are not financial advisors.
Right.
Everything we're talking about is just
you
for
do your own research.
Right. It's just for education, right? Okay. So let's go. Let's get it. The goal, of course, of this video is to help you in determining what to invest in the stock market. So this is, again, segment 3. So we already talked about what the stock market is. If you don't know, go back and watch that episode. You should have already created a brokerage by now. That was the last episode. So now we're going to talk about how to determine what to invest in, which is, step 3, for this segment. So, yeah. So choosing companies to invest in, right? So let's kick it off. So the first thing you want to do is going to be 10 factors, by the way. We have 5 on this page, and then there's another 5 on the next page. So first thing is financial health, right? So what does financial health mean? You want to help with that?
Yeah.
Help us
so
out.
Financial health is the,
Wait.
Let me see.
It's right here, man.
Yeah, I can't see. Okay.
Hey, real quick, guys, we do our own notes, okay? We don't, it's just really just to help us guide and stay on track, man. So we're not just reading a book to y'all. This is our own notes written down, guys. So anyway, but go ahead.
Okay, it's the company's revenue, profit margins, and debt levels. So you want to pay attention to their financials, basically. Are they in continuous growth?
Yeah. Examine a company's financial statements, including revenue, profit margins, and debt levels. You want to look for consistent growth and profitability. Basically, the fundamentals of a company, okay? So what is fundamentals? Fundamentals is basically, your financial statement, the balance sheet of a company. Believe it or not, some companies aren't profitable, guys. Some companies, they make tons of revenue, but that bottom line after all expenses could be a negative number, right? Sometimes it takes a company years before they're actually profitable, but that doesn't always mean it's a bad company, right? You just need to know if the type of company you're invested in is the fundamentals sound for your strategy, right? One website I love to use, I'm gonna try to write it right here. Well, you mind helping me? Just write it.
Yeah.
Just right underneath financial help. A great website, guys, that y'all can use to help you research all the companies that are public on the stock market. It's called macrotrends.net. Macrotrends.net. We definitely use that website quite a bit. It's a great tool, guys. I mean, literally, if you're curious about pretty much anything related to the company's financials, man, that's like the best resource, in my opinion, that you can use. So I highly recommend using macrotrends.net, right? Yeah, so that's fundamentals. That's basically financial help, guys. It's the fundamentals of a company, right? So the second thing we have on here is the industry and market trends, right?
Yeah.
So you do want to research which industry the company you're interested in investing is in and its growth potential, right? Consider how market trends may impact the company's future prospects. So there's there's 10 different sectors in the stock market, right, guys? Okay, so you have, technology, healthcare, finance, consumer discretion, energy, industrials, consumer staples, utilities, materials, and real estate. So those are the top 10 sectors in the market, right? So you do want to know which industry that you want to invest in. For us, it's tech. We love technology.
Right.
Majority of our TD Ameritrade portfolio is tech. Five different companies that we actually invest in. We're going to explain that later. Not in this particular video, but yeah, we do have in that particular brokerage five technology companies that we're invested in. Actually, one of them is consumer discretion, by the way, but it could be considered a technology company. I wonder what y'all thinking it is when I said that. Pretty sure somebody probably guessed it, but anyway. And then of course the future prospects, right? So what does this company's future look like? Does it look like it's maybe obsolete?
Right.
Or maybe this company got at least another 2 or 3 decades in them. You just want to consider the future prospects of the particular company and the industry you're in, because some of these industries may become obsolete, maybe, or
think about the companies that have already become obsolete. Like
exactly.
Blockbuster is no longer here.
That's one, right? Toys R Us.
Toys R Us.
That's another one. Yeah.
I think they're opening back up.
I'm not sure, man. I mean, I haven't seen one in years, so. The only one we had out here in our city, man, it's been gone. So I hadn't seen one. Even when we travel, I haven't seen one.
Right.
But anyway, so make sure you know which industry and market trends of the company that you're invested in or want to invest in is, right? So the third thing, guys, is the competitive advantage. So determine if the company has a sustainable competitive advantage, such as a unique technology, strong brand, or a large market share. So you want to touch more on that competitive advantage?
Yeah. So.
Oh yeah, I like that Moat. Yeah.
The Moat is basically that is the strong brand. Like, for example, a Coca-Cola. Some people say, "Give me a Coke." And they're not necessarily talking about an actual Coca-Cola. They're talking about just a soda. So that's the Moat. Like, Coca-Cola is such a strong brand that now it's the face of soda.
Yeah, I mean,
that's one example.
Well, it's just like a metaphor, right? Like when you look at an actual moat that surrounds like a castle, something that basically someone can't just easily copy or mimic. Like, it's a brand name, for instance, like she mentioned Coke, you see Coke, but it's not Coca-Cola, right? That's the thing. I think that's what you was trying to say.
Yeah.
Like, or even like Google, like, some people look at search engines or anytime they want to search something, they say, Google it.
Right.
Okay. Google, that's a moat, right?
Right.
So, companies like that are blue chip most of the time. They're not easily to mimic. Other companies may come into the marketplace. They may not have, a competitive advantage to compete with a particular company, right?
Right.
So you definitely want to make sure it's highly recommended that you invest in a company that has a competitive advantage, right? But yeah, Basically, that's what a moat is, guys. It makes it difficult for other businesses to compete effectively. It's a metaphorical reference to a protective moat around a castle, like I mentioned earlier, which makes it challenging for attackers to breach defenses. Okay, so that's pretty cool. So make sure the company has a moat, right? So number 4, the management team of a company, right? You want to evaluate the company's leadership, team's experience, and track record. Trustworthy and capable management is crucial. Crucial.
So do they have the same values that you have? So look into who the CEO is, who owns the company, who runs that company, and do they have those same type of values that you want? That you look for.
Yeah, I mean, you look at some of these CEOs out here that are, some of them get crazy with their tweets. They may say something off the record and it goes to the public. And I mean, CEOs, man, they have to be very, very cautious with how they act because it can definitely have an impact on the company's stock, the company's valuation.
And are they innovative? Are they constantly talking about new things that they're thinking up for this company?
Yeah. I mean, and to be honest, man, you think about it, the stock market really is just an emotional place. Like when you see the volatility, it's because people are getting emotional. They're either reacting off of some news, maybe it's some fear that they have, or greed. Usually when the market's trending upwards, it's greed. It's extreme greed. And when, of course, it's downtrending, there's fear. So, and honestly, we personally like when there's fear in the market because that's opportunities. You get shares at a discount. So that's just another thing to throw in there as well, right?
Yeah, that explains the bear and the bull, in case people didn't know that.
Yeah. Bull market's when the market's trending up. Bear market's when the market's trending down. So, yeah. Okay, so guys, basically make sure, you do your research, understand who the CEO is, the CFO. I mean, all that stuff is important. The whole board, that's an important thing to know. Definitely know who your CEO is that you're investing in. Because you are investing in the CEO. I mean, you're investing in their company, but you technically are investing in that CEO, that chief executive officer, right?
Yes.
Yeah. Okay, guys, so let's keep it moving. Number 5, the valuation. Valuation. So you want to analyze the company's valuation, including its price to earnings ratio, other valuation metrics, right? Ensure it's reasonably compared to peers and historical averages. Price is what you pay, and value is what you get, right? Okay, so the valuation. I'm gonna take over on this one. So, if you ever look at, if you go on Google, guys, type in the ticker of a company, and you look at the bottom underneath the graph where it shows the chart. Usually there's something called market cap, right? Market cap.
Yeah.
So market cap is short for market capitalization. Okay. All market cap or market capitalization represents is the valuation of that company in as far as in dollars, right? Monetarily, what is the company worth? And how you actually get the value of a company is you take the shares outstanding and multiply it by the share price. And that's going to give you the market capitalization of the company, which represents how much value is in that particular company, right? So for instance, like Apple, it's a company, we actually invest in Apple. Their market cap currently is just shy of $3 trillion. So if you take their share price and multiply it by the shares outstanding, that's how you come up with that valuation, guys. So I highly recommend that you invest in a company that has a decent market cap, because a company that's dying in most cases, or low billions, that's what's crazy too. A low billions company could be pretty much not even worth investing in, nowadays. You want a couple $100 billion, in my opinion, in the company. That's just our criteria, by the way. These low cap companies that don't have high market capitalization potentially could be extremely volatile. Sometimes the volume may or may not be there. Volume is how many people are buying and selling in that particular company.
Right.
So just something to think about. Valuation is very, very crucial when you're looking at a company to invest in. So do your research, look at the company's valuation, and make sure that it meets your criteria.
Right.
Anything you want to say about that? No? Okay, let's keep it going. I'm going to flip the page. All right, guys. So number 6 on how to choose a company to invest in the stock market. Dividends and share buybacks. Dividends and share buybacks. Okay. So if you seek income, check to see if the company pays a dividend or buys back their shares, as this can provide a steady return. So we touched a little bit on dividends in a previous video that we did. Dividends is basically when the company, is positive cash flow. Usually they'll pay their investors in the form of a dividend. Apple is another company, using Apple as an example. They pay dividends. I believe they pay quarterly dividends. Yeah. So, some companies, they may pay monthly, some they may pay quarterly. It's usually a good strategy if you're in the market to attempt to receive some, monthly or just any type of residual income from the company.
Right.
Almost like a cash flow.
Yeah.
Yeah. And you can also reinvest your own dividends. Like that's what we do. So anytime the companies that we invest in that are paying dividends, when they pay out a dividend, it automatically gets reinvested. It's something called a DRIP, which stands for Dividend Reinvestment Program. You can set that up whenever you're setting up your brokerage. If you happen to invest in a company that pays out a dividend, it's just a click of a button and it turns all your dividends into reinvested shares.
Right.
So, and now your interest is compounding interest. So it's another good way to help increase your portfolio. Yeah. The value of your portfolio.
So it's not a payout. It's just reinvesting. So you're earning more shares.
Right. And it's also another strategy to, kind of defer those taxes. We talked about taxes on shares as well. Anytime you take your capital gain, there's a tax you have to pay on that capital gain. So those dividends could be taxed. A capital gain tax if you take them in the form of income. So, right. And then of course the share buybacks, that's basically when the company is doing quite well, they buy back shares in their own company. So a company that's doing that, that's a great sign, guys. Make sure, you do your research. If a company is buying back shares of their own company, obviously they believe in their own company enough to want to buy back even more shares. Yeah. So that's definitely something to look for in a company to invest in, right? So let's keep it going. Did you have anything else you want to touch on that particular topic?
No, it was kind of non-related, so we can keep going.
Okay. So the 7th thing, guys, in choosing the company to invest in, growth prospects. Growth prospects. So you want to assess the company's potential for future growth, considering its product, services, and expansion plans. Okay. So like she mentioned earlier about innovation, right?
Yeah.
Is this company doing anything, or are they talking about doing anything in the future, right? What are the future products and services of this company? Like let's go back to Apple. Apple, right? They have this cool product coming out next year. It's called the Vision Pro. If y'all haven't seen that, definitely go check it out on Google or YouTube. You can check it out on YouTube.
Yeah.
Man, it's gonna be pretty dope. It just shows you where we're headed, like in the direction of the future of where the world is going. That's just one product in particular, but that's innovative, right? I've never seen anything else. Even this iPhone that we're shooting this video on, that's innovative, right? It came out in what, 08, 07, something like that. I think iPhone 1.
Yeah.
I remember watching that video. That's another video I'll go check out whenever they introduce the iPhone. If you haven't seen it, it's amazing. Like people tripping out over
because
how
it's one button.
Yeah, like it's no buttons on the phone. And when to unlock the phone, you just slide it over. Everybody went crazy when they seen that. That just shows you how far we've come.
Right.
Like, back in the day when that was something that was innovative. But, guys, make sure you're paying attention to the growth prospects of a company. You want to make sure that they're going to have things to look forward to, not be another blockbuster.
Exactly.
Yeah. So number 8, right? Mm-hmm. Risk factors. That's the 8th thing you should look at when you're choosing a company to invest in. Mm-hmm. You want to identify potential risks, such as regulatory, competitive, or economic risks that could impact the company's performance. So, you look at economic risk, right? That's one example. Some companies have to pivot. Think about going like a lot of these companies. I don't know if y'all been paying attention to certain ads, but they want to be zero carbon by 2030, whatever. I know Apple's back to Apple. They want to be zero carbon with their products. So, look at a company who has any type of associated risk that maybe something that's probably going to be more on ESG. But also, you just want to make sure that they're not having anything that could potentially interfere with their products and service. Like sometimes, regulation could be an issue later down the road. Just pay attention to what the future is. It a positive or negative impact within that company's product or service, right? You know what I'm trying to say?
Sort of.
Yeah. Okay. Like for instance, like let's talk about like fossil fuels. Yeah, it's a big topic. With that's why you see a lot of companies, automobile companies starting to come out with electric vehicles or even hydrogen vehicles. There's a big talk about fossil fuels are going to be obsolete. Yeah. They're going to be a thing of the past. Yeah. Obviously we're not if you pay attention, but for a company that's not willing to convert or have a product such as an electric vehicle, well, they potentially may become obsolete. If they don't keep up with the times and have that product available for consumers, right? So it's just that's kind of along the lines of the risk factors to think about in a company that you want to invest in, right? Mm-hmm. And that brings us to number 9, which is
it's kind of ties together.
Yeah, it's pretty,
ESG basically stands for environmental, social, and governance factors.
Yeah, governance factors. Yeah. Right. Yeah, you want to assess the company's sustainability and ethical practices. Okay. So we were just talking about this. Remember, we were talking about the social media. Man, they stay in court and under scrutiny, like for regulatory things, man. But to be honest, man, it has to be regulated. It's almost like they created a car without a seatbelt. If you want to use that analogy.
Yeah.
Yeah, it's very, very. It could be detrimental. Or not detrimental, but
it has
it's damaging. It has been. It affects certain people's, mental state. It just depends on how you use it, guys. Like as far as how I look at social media, me personally, it's all about how you use it. Like you can use it for good or bad, right?
Well, I say detrimental for mainly kids who's underdeveloped.
Yeah. It has been for the most part for them too. Yeah, but that's an example, guys, of ESG factors. You want to consider that. The environmental, social, and governance of a company, just to see, kind of back to risk factors, how it can be a risk, investing in a company that may have these issues in the future, right? Yeah. And then the last thing, guys, is diversification. Diversify your portfolio by investing in companies from different industries and sectors to spread risk. The challenge is really finding companies that meet all the above criteria, right? Everything we just touched on. Yeah, that's very challenging to do. Find a company or companies that have the criteria that we mentioned. Mm-hmm. But it is important to spread your risk. That's very, very important. Diversify your portfolio to a certain extent. I'm not telling you to buy the entire stock market, right. But I'm telling you to, we like, for instance, with us, we like to invest in individual companies, right?
There's a lot of factors, mm-hmm. like people's age could be a factor in the way that you choose what companies mm-hmm. to invest in.
Yeah, how
like
aggressive
because
you
we're
be.
Younger,
right.
We're able to invest in the company itself.
Be a little bit more aggressive.
Right, because there's ETFs that you can invest in where, again, like
and that pie ETF? Chart.
Exchange, what is it? Exchange
Got a blooper.
Trade fund.
Exchange traded funds.
Yeah.
Yeah, I like when I hit you off guard like that.
Okay, so it's basically like an umbrella. We talked about it in a previous video, but there's different. Yeah, I just said that.
I said umbrella.
That's how I think about it. It's an umbrella and many
explain
things.
That analogy to me.
Okay, so an umbrella, mm-hmm. there's many things that fall underneath it. So different sectors that fall under
I'm gonna let you
an
live.
Umbrella.
I'm gonna let you live.
I know I got some people in the comments.
I like the basket analogy better. But I like that too.
Okay. Anyways, those are usually less aggressive because they're spread out. Like the pie chart analogy that we use, mm-hmm. It's just multiple things in one. So you invest in one company, but you're getting a little piece of multiple companies.
Well, it's not one company, it's one portfolio.
That's what I mean.
Yeah, it's one portfolio of companies.
Yes.
So just helping you out, man. That's all. You know, we a team.
Yeah.
So I got to make sure, you know, I keep you on the up and up too. But anyway, guys, so look, before we explain the exercise, I didn't really touch much on technicals, but I do want to do something real quick with y'all. So look, now we talked about financials of a company and technicals of a company. So whenever you look at a stock chart, you're going to see, you know, if you can pick a 1 day chart, you can pick a 5 day, a 3 month, a 6 month, a year to date,
And a max.
a year, a 5 year, and then like she just mentioned, the max, which is from inception. So depending on which chart you're looking at, you know, it's going to look something. Let's just say if you pick the chart from its inception, well, let me just do 5 year chart, right?
Okay.
So you look at a chart, it may look something like, you know, something like this. I don't know if y'all can see that well, but you know, this is usually what like stock charts look like, guys. You know, when you're looking at it on a graph on, you know, like Google or whatever. So preferably when you're looking at a chart, you don't want to buy whenever a stock is like trading in this area, guys. Because look, this is technically like the all-time high of the company.
Right.
So people that are buying up here, right, this is normally what people are probably selling because it's trading at an all-time high. Mm-hmm. So they're taking their money, exiting temporarily or a portion of their proceeds or their profits and parking it elsewhere, right? Or they may be allocating it to buy back shares later, preferably when it comes back down to something like this. Right. Another thing when you're looking at a chart, like the way I did this, technically, like, I mean, the technicals. So like something like this, you'll see some people draw like a line like this that would represent like support, right? So if it breaks below this support, like if the stock was to come down here, well, guess what? That's a great buying opportunity because it's broken this support line, right? So that's another kind of way to look at stocks technically. And then of course, resistance. So another thing is resistance. You know, if you look at, you know, some people may draw another line like this. Again, you don't want to buy up here. It's all-time highs. And this basically it's like a resistance, like the stock is struggling to get past this particular spot, or it may break. Like let's say if this was the resistance and it breaks through this, you know, resistance again, you know, all-time highs, you don't want to buy up here.
Right.
This may look crazy, but I'm trying to give y'all something tangible to look at, right? So whenever you see companies stock, you know, come down to these levels, guys, don't get nervous, don't get scared, don't get out. Stay long and strong and don't pull out, like we mentioned before. Right. So you want to stay in, stay strong, buy up as much as you can, because look what's going to happen. Boom. Potentially, if you're in the right company, you're going to hit new highs and your stock portfolio is going to grow and grow and grow. Yeah, and it's going to compound interest. So I hope that made a little bit of sense. You know, that was my goal. And if it didn't, guys, stick with us. You know, we're going to continue to give y'all more game on what we know and what we research and how it works for us. You know, we want y'all's stock portfolios to grow just like ours is growing, right? Right. So that's kind of leading up to the exercise. So we want y'all to find companies that meet the above criteria and start your journey. Don't procrastinate. You know, start researching. You know, do your due diligence. Everything we just mentioned here, the 10 steps, the 10 factors to consider. Do that on every company you select. Run down all 10.
Your checklist.
It's a check. Yeah, use it like a checklist, right?
And bottom line is you want to choose quality companies. Right. And you never lose money until you sell.
Right. Yeah, exactly. Yeah. You never lose until you sell. So, yeah, guys, like I said, price is what you pay, value is what you get. Never let the share price limit you from wanting to buy into a particular company. And by the way, you can buy fractional shares now. I was just about to say that. Certain brokerages, back to researching your brokerage, if you can only afford to maybe do fractional shares of a company, then make sure you're in a brokerage where that's allowed, where you can purchase a percentage of a share. Like for instance, if a share is trading at, $100,
Yeah.
oh well, yeah, 300, whatever, but you only got $100 and it's trading at 300. Well, you can buy 1/3 of it with 100. Okay, 33. What is that? 33%. Yeah, 33%. Right. So yeah, guys. So that's pretty much this episode of Marriage, Money, and Mindset. Guys, make sure y'all like, share, comment, subscribe to the channel. Right. The next episode we're gonna have for y'all is gonna be how to exit the stock market. That's something I don't really hear a whole lot about. So we're gonna dive into that, how to actually exit the stock market. And that's gonna be a good episode too. So make sure y'all tune in for that one. Yeah. So anything else you have to say before we sign out?
No. Stay tuned.
All right, guys. Appreciate y'all. Y'all have a great week. We'll see y'all next week. Take care.
Peace.